with topic 1, financial statements. A financial statement is a really good tool as well as information, okay? From your perspective, you want to know if you're making any money in your business. Why are you at this if you're not going to make any money, really? So a financial statement is a way to measure, it's like a measuring stick, to be able to determine whether or not you're making any money. Is your business living up to what you consider to be your expectations? You need to make enough money in order to stay in business, okay? So a financial statement will help you with that. But it will also be a very important tool, and this is what accountants do, a very important tool in terms of obtaining credit. Because if you need to expand your business, the first thing a bank or a potential investor is going to do is want to see that your business makes some money and that it has an ability to pay off that loan or to be able to continue into the future. So a financial statement is important to do that. Now, if there were not any rules or any processes around financial statements, your financial statement could be different than someone else's financial statement, could be different from someone else's financial statement. What I mean by different is the way that they're calculated, okay? The way they're calculated could be entirely different. So what accountants and the accounting profession has done is they said, what we need to be able to do is to create a ruler that has the exact same measurements on it for everybody. No different than you would have for a ruler or a gauge that you would use in your work. A financial statement is a standard outfit, a standard tool that is used in the accounting profession to be able to gauge how well a business is doing. And your job here, or what I want you to take away from it, is to understand some of the very basic key components of financial statements and to be able to read them to the extent that you'll say, yeah, this is a good business, or no, this is not such a good business. Or yeah, this is worth pursuing, or no, this is not so worth pursuing. I can also look at my business and say, okay, I can look at my financial statements and say, okay, I made $30,000 this year. How much does a business similar to mine make? What is the average? Is my business better than average, less than average? You know, do I have a good business going on here in terms of the management of the process? Is it being managed well so that it's doing as good or better than businesses of comparable size? The government also want to see your financial statements for the purposes of taxation. You know, we all pay tax. So one of the things that Revenue Canada is going to want to see is your financial statements for the purposes of assessing how much tax is applied to your business. So financial statements are very important for all those purposes, internally, your purposes, and externally for investors, banks, and government. So how do they basically work, or what's involved with them? Well, so effectively, there are two major financial statements that we need to concern ourselves with as small business people. There are others that accountants want to concern themselves with, but you as a small business person are going to want to know two in particular. And these are the ones that are the most common, the most used, the most well presented in terms of, you'll see these commonly for small business. You'll see them in financial statements, in magazines, booklets, textbooks, whatever you want to call it. You'll see these things a lot. So the two that we're referring to are something called the income statement and another one called the balance sheet. And the income statement is a pretty understandable one. You know, it measures income. But okay, pretty straightforward. What in the heck is a balance sheet? Well, a balance sheet is a tool to determine how much your business owns. Okay, it is like a snap camera that will take a picture of how much your business owns at any given point in time. So it's a point in time statement. The income statement measures, it's like a measuring tape. It measures how much money you make over a period of time. So the income statement is a period statement, meaning it will measure in a period, usually 1 year, whereas the balance sheet measures a point in time to say, this is what your business looks like right now, a snapshot, more or less. So we're gonna look at two of those tonight and get an understanding of how they work, each one of them work, and how they relate to one another. So we're gonna look at the purpose of the income statement and the balance sheet. We're gonna look at the interrelationship. We're gonna look at some of the basic bookkeeping principles. Again, this is not an accounting course. It is designed to give you an appreciation for it, okay? But you can do a whole course on this sort of thing. And financial statement analysis. That's another thing that we're going to talk about, which is really being able to use these financial statements to determine whether your business is going in the right direction, okay, from a management point of view. The very first thing you have to think about whenever you think about this, and accountants will say to you, you need to think of your business as something called an entity. An entity means that it's separate from you, okay? In order to be able to measure a business, you don't want to mix it up with you, meaning that money that you make versus money that business makes. Because if you muddle it all together, it's very hard to tell. So we need to separate out the business so that we can measure if it is making money, or it is losing money, or it is performing well, or it is not performing well. So accounting is premised on this idea of the business being a separate entity from you. You may own that separate entity, but it's like a baby, okay? It's separate. And so all the transactions, all the comings and goings of money, revenue earned, expenses paid, have to be related to the business. So what we're doing is measuring things related to the business and using it. So it basically has its own little bank account. You can consider a business as being separate and set its own little bank account. So you need separate accounting records for your business. So every business has a separate set of accounting records in order to be able to differentiate whether a business is doing well or not. So the financial statements are really designed around this idea of it being a separate entity. Okay. Now, so the financial statement, the income statement, and the balance sheet is really kind of a measure that accountants use, as I say, and it's separate, so you can judge the business as opposed to muddling it with the owner of the business. The written records that show how the business is doing. They're important for other businesses and other businesses such as the banks and the government, and they really allow you to figure out how much you, as the owner of that business, own your investment in it. We'll call it your investment in that business, because even though the business is separate from you, you own it. And if you folded it up tomorrow, you would get all the benefit from it, right? It's yours. And this bit that you own is called owner's equity. Equity is just a word for how much you own of something. So the business has what's called owner's equity. So in order to be able to understand how we record this, you have to understand some of the basics of these basic financial statements. So the first thing we're going to look at is something called the income statement. Now, in order to understand the income statement, what I need to be able to do is to get you to think about a timeline. Okay, this is kind of busy, this little thing, but here's the timeline. I just want you to look at it. Let's pretend that we're going to start our business and we're going to run our business. So let's assume that our business is going to start, for our purposes, we're starting it on January 1st. For the purposes of accounting, January 1st, let's assume last January 1st, we opened up our business. And we're going to run our business right through the year. And at the end of the year, December 31st, we're going to tally it up to say, is this business making any money? Is this business working for us? So we'll start January 1st, right through the year to December 31st. Now, let's march down to the beginning. The beginning is January 1st. Now, at January 1st, let's assume that we start this business. Now, when we start this business has to have something that will generate some money. It has to have something. So, Harrison, I'm going to steal your shop. Now, I'm going to steal your shop. So, let's assume that you got a business and you got two pieces of equipment in that business that you can use to make money. Your business is a machining business, and you got two pieces of equipment. You got a lathe and a milling machine. And you got these two things, and January 1st, you're going to put them in the business. So do you physically put them in the business? No, you don't, but they're going to become part of the business. So let's assume that You say to yourself, 1st of January, they're going to become part of the business. How much are those pieces of equipment worth? $20,000. Let's just say $20,000. So on paper, you're going to start a business that has $20,000 worth of what we call assets. Now, assets is a word that describes what the business owns that is used to make money. Okay, so that business is going to have $20,000 in assets. And where'd that $20,000 come from? You gave it to the business, right? You own that piece of equipment before you give it to the business. You give it to the business. And if you shut the business down tomorrow, you get that piece of equipment back. So let's assume then that it's worth $20,000. So you have a stake in that business of $20,000. The assets of the business and the stake in the business of $20,000. So this is the beginning. This is the beginning. Throughout the year, which runs from January 1st through December 31st, you're going to do work in that business. You're going to be that business, separate entity, but still you're going to be the one doing the work. So you're going to be milling and machining and all this sort of thing. You're going to do some jobs for people, and you're going to get some money come in. Okay, the money comes in called revenue. That money comes in, and let's assume that the revenue flows in through the business, through the life. And at the end of the year, December 31st, you're going to add up how much money that business generated for the year. Okay? You're going to add up the total amount that it generated from the year. Now, that would be considered the income. So those assets that you put in place at the beginning of the year generated income throughout the year, and you're going to add all that up. But you also had expenses. You know, you had to pay somebody, you had to turn on the lights, you had to heat the place, whatever. You had a bunch of expenses. And you're going to add all them up too. So at the end of the year, you've had a certain amount of revenue come in, and you had a certain amount of expenses. If you took the revenue and you subtracted the expenses, you'd be able to figure out how much money you made in profit. In other words, how much are you to the good? To the good. So let's say that you did, I don't know, $10,000 worth of work, and you had $4,000 worth of expenses. You were $6,000 to the good. Okay? So your business made $6,000 in profit. So our income statement is really measuring that flow of money in and out. At the end of the year, December 31st, you're going to develop that income statement, which is basically a measure of revenues minus your expenses. And you're also going to do what's called an ending balance sheet, which is kind of a tally of how much the business is worth. We're going to take a picture of that business on December 31st. Well, how much is it worth? Well, in simple terms, the lathe and the milling machine is still there, and it's worth $20,000. The business also generated $6,000 in profits. So if you shut down the business today on December 31st, let's assume today is December 31st, you would have, that business would owe you the equipment back, which is $20,000, plus the $6,000 that were made. So you'd end up with $26,000. You'd be $6,000 better off than when you started. So effectively, that's what financial statements do, is they just do these measures. They allow you to do these tallies, and they represent what the business had at the beginning, how much money it made during the year, the flow, and how much it was worth at the end. So balance sheets measure how much it is worth at some point in time. So at the beginning of the period, we do a balance sheet. At the end of the period, we do a balance sheet. Basically, you do a balance sheet once a period, because once you do, I got two here, but when in the business's next iteration, next year, the ending balance sheet will be the beginning balance sheet for the current year. So you're going to have an idea of how much the business is worth to you at the end of the year, and you're also going to have an idea how much money the business made for you during the year through the income statement. That's effectively what those two statements do. Now, that's the overall simple, super simplified version of the balance sheet and the income statement. Your banker is going to want to look at those to ask that basic question: is the business worth investing in? Now, your business made $6,000. They might look at it and say, hey, that business makes money. It can pay back a loan. Yes, I'll loan it money. That's the idea of the financial statement, right? To be able to demonstrate to a lender that this is worth money. So, as I say, these are the two statements. The income statement is a pretty simple statement that measures flow. It's like a movie camera, right? It measures time. So it's a profit and loss statement. That's another name for an income statement. Core company financial statement shows revenues and expenses, which is really net profit or net loss, how much when you subtract one from the other, for a given period of time. So time, the period of time is critically important in order for an income statement. It measures how much made in a period of time. Could be a week, could be a month, could be a year. Most times it's a year, but there's no defined rule that says it has to be a year, but it's over a period of time. So it shows the company's ability to generate sales, manage expenses, and create profits in a period of time, which is important for a banker or yourself in order to convince you to continue in that business. For comparison purposes, often more than 1 year of information is presented. So we want to know, as we move into our second, third, fourth, fifth, sixth year, we do this and we look at each of the income statements for the years and we ask ourselves, are we making more money each year, less money each year, the same amount of money each year? You know, if you're in business, you're going to want your business to grow. So your goal is going to be to increase your income as you go along, not have it go down or anything like that. So the income statement will give you a good measure over time to say, hey, yeah, this business is worth pursuing or this business is not so good. So the income statement is simply revenue less expenses over that period of time. So money coming in and money going in. So let's consider a simple example where you start your business on January 1st last year. The year has just ended. December 31st has just gone by. So the question that I would ask then is, how much in this little scenario did you make in profit? Okay. So look at these 4 points I have here. Your business did 3 jobs during that year and earned revenue of $10,000 on each job. So in terms of revenue, is 3 jobs times $10,000 each. That's $30,000, right? So your revenue was $30,000. Your business incurred total of $5,000 in expenses for supplies used. Okay, so we got 5,000. I'm just going to put a minus in that because that's money that you're spending. Okay, minus 5,000. And what else did it do? Your business incurred, rented a building. That was $10,000 that you had to pay out. And you paid 10,000 salaries. So our profit is simply $30,000 that came in minus total expenses. In this case, the total expenses, let me just put a thing there, is $25,000, right? You had $25,000 if I've added up that correctly. So $30,000 then minus the $25,000 will give you a profit of $5,000. So in this little simple scenario, your business made $5,000. You brought in $5,000 more than you spent. You might be satisfied with that and say, that's good. That's the amount I want. You know, if you're dealing a multi-million-dollar business, you made $5,000, probably not such a good idea. If it's a little shop in the backyard, you might think, hey, that's great. I don't mind that. That works good for me. Again, it's a 1 point in 1 year. Over the course of years, that will change. So this is how basically an income statement works. Pretty simple. The balance sheet measures what the business owns and owes on a given date. And the balance sheet is figured out or calculated at the end of each, what we call cycle. And if we look at this, this is exactly the same as I just showed you with the timeline in the previous slide, but it's a circle because every year, we call it a cycle because every year a business goes through another accounting cycle, it's called. From January 1st to December 31st or beginning of a period, April 1st to March 31st, Usually it's a year. It doesn't have to start. It doesn't have to match the calendar. It could be what's called a fiscal year, which means that it starts at some point during the year and ends 1 year later. But effectively, we can use the income statement to measure change, and the balance sheet is a snapshot to measure what it was at the beginning, what it was at the end. So the balance sheet has 3 parts to it. 2 parts, but there's really 3. If we look at the 2 parts, a balance sheet just looks at the business as an entity, a separate entity, and it says, what does that business own? The things that the business own, and what does the business owe? So 2 sides, and those 2 sides will always be in balance, and we'll show you that why they'll be in balance, and this is why it's called a balance sheet. So a business, what it owns is normally called its assets. Assets are things that it uses in order to make money, okay? So you can think of assets in terms of its investments or its tools or its things that are used. Now, assets come under different classifications. There's something called current assets, stuff that's really easily converted to cash. Fixed assets are like property and equipment. Investments are just money that's stored away, making money. Or something called intangible assets, which are things that aren't real, but are valuable. Think of the name Tim Hortons, for example. If you open a Tim Hortons shop, it was sell based on the fact that it's Tim Hortons, right? So that name is what is an example of an intangible asset. It's nothing, but in the eyes of the buyer, it is worth. Adds value. The McDonald's name, the McDonald's sign, the Tim Hortons logo, all that means that customers say, yeah, I value that. So we have assets, and assets will always match. In other words, they'll be what's called equal to what the business owes. And now what a business owes is broken into 2 parts. What it owes to outsiders and what it owes to insiders. Now, outsiders are people that the business owes money to who, for example, have no control over the business. Banks, for example. The bank loads you a bunch of money and you got to pay them back. That's what's called something that's owed to outsiders. And we have a name on that called a liability, meaning that the business owes it outside the company to somebody else, and it has to pay that. Now, the business also has money that it owes to its owners. That could be you. When you start the business, and you put money into it or you give it assets, so it's that lathe and that mill, the business owes you that back, right? Because it's a separate entity. It owes you that back, and it reflects that in this balance sheet as what's called owner's equity, which is a liability that's owed to you. So effectively, assets are on one side of the balance sheet, what business owns. And what's on the other side of the balance sheet is what business owes, and that's broken into 2 categories: liabilities to someone else, and owner's equity, which is money that's owed back to its owners. So the balance sheet is a snapshot. This is what the business has, what it owns, and what the business owes to outsiders and insiders at any point in time. What it does is it shows you at the end of a period how much that business could be liquidated for. If you squeezed it, if you brought the business together, you sold it, whatever, this is how much it's worth. At any given point in time, this is basically how much it's worth by taking what it owns and subtracting off what it owes to outsiders. Everything else is yours. Basically, you're the owner's equity. So a business, for example, would have a certain amount of what it owes. Let's assume that it owes someone $1,000. You go borrow money from the bank. You start your business and you go borrow $1,000 from the bank. The business borrows $1,000 from the bank. So that means the business owes $1,000 to the bank, right? But the business, because it got that $1,000, it also has that $1,000 that it borrowed in its bank account, which is an asset. So it has cash. So you'll notice that the $1,000, even though it's owed to outsiders, it has 1,000. So this side of the balance sheet and this side of the balance sheet, what it owns and what it owes, will always be in balance. let's take our basic simple example and let's consider it. Now, as I say, the balance sheet is a period of time. So let's do what's called the beginning balance sheet. So if I go back, if I just slide back here to our initial example, on January 1, we're going to start up this business. Okay, on January 1, we're going to start up this business and we're going to have what's called a beginning balance sheet. In other words, this is what you as the owner are putting into the business. Okay, so in this particular case, on January 1, you placed the lathe and mill in the name of the business and it's worth $20,000. So let's think about it. The business, separate entity, has just been given a lathe and a mill. So in terms of its asset, what the business owns and can be used in order to make money, there is can't do that. There is $20,000 in value of the assets in the business when you put that lathe and that mill in the business. Now, you just gave it to the business, and we also know that, well, the balance sheet has the balance. So I got $20,000 on one side. Let me put it down here just so I got it. You got $20,000 on one side of the balance sheet. What goes on the other side of the balance sheet? Well, keep in mind now, you are the owner of the business, and you gave the business that $20,000 lathe and mill to start up. So effectively, the business owes that back to you. In other words, the owner's equity that you have, I'll put it $20,000 up here. The $20,000 that business has, the value of the equipment, is owed to you. It comes under owner's equity. It's $20,000. Hence, our assets, which are one side of the balance sheet, will match our liabilities and owner's equity side of the balance sheet by $20,000. So this is what we have at the beginning of the period. So this is day one. Your business just started. Now, you start running your business. Now, we saw in the income statement that we just completed that we ran our business through the year. Let's run our business through the year. Now, I'm just going back to that slide that we completed where we ran our business through the year. And what did we make? $5,000 profit. Okay, we ran our business, the income statement. So now we're at the end of the year now. We're on our timeline. We started it. We started our business. We put the lathe in the business. We had $20,000 worth of assets in the business, $20,000 worth of owner's equity. We ran the business through the year, did a bunch of jobs for people. We made $5,000 to the good because we $30,000 in revenue, $25,000 in expenses, $5,000 to the good. And now we want to generate a balance sheet for the end of the period. Okay, the end of the period. Well, how do we do that? Well, if we go down here and we say, okay, we worked through the year now. We've made our $20,000. We've got a beginning balance sheet of $20,000. Let's think about it. Well, you had $20,000 is still the lathe and the mill is still in business. There's $20,000 worth owed back to you because the business owns it. And I'm going to put that $20,000. That lathe is an asset of $20,000. So we'll see that our balance sheet is in balance, meaning there's $20,000 in assets and $20,000 in owner's equity. But also during the year, we ran our income statement show that we made $5,000. So that means that there's $5,000 more in the bank now because we made it. So I'm going to add $5,000 there came in terms of extra money. Now, keep in mind, if we shut down our business tomorrow, we get all of that money back. So really that $5,000 profit from the year's operation increases our owner's equity. In other words, $5,000 increase in owner's equity. So our business now is worth 20 plus the 5, 25,000. The asset, the equipment, plus the $5,000 extra that we made in revenue is $25,000. Our balance sheet is in balance, meaning the assets equal liabilities plus owner's equity. And it's gone up by $5,000 because we operated during the year. In order to make any of this work, there has to be some accounting standards. As I say, accountants need to agree that, yeah, we're going to use a standard method for measuring money coming in and money going out. So things like, how do we recognize revenue? You know, if you go do a job for someone, let's assume you do a job for someone and you haven't got paid yet. Well, you haven't got any money. So how would you reflect that in your income statement? How would you reflect that in your balance sheet? Well, we know that that's revenue, right? That you make money. So that would be in the income statement. You've earned it though. And accountants say, look, the very fact that you earned it makes all the difference. You may not have actually gotten the money yet, but you will. So in the income statement reflects revenue earned as opposed to actual dollars coming in. So if you did $40,000 of work, you haven't got paid yet, you would reflect in your revenue that you made $40,000. It wouldn't show up in your cash. It would be accounts receivable. Measurement of liabilities, same thing. You owe the light bill. You haven't paid the light bill yet. Well, you still need to recognize that you owe the light bill. So there will be a liability for what's called a payable. Money is owed to the light bill company. As I say, revenue recognition, you record revenue as it happens. So the fact you haven't gotten paid didn't matter. And expense recognition is you record the expense as it happens. Ultimately, the balance sheet measures this idea of shareholder equity, which is how much money that business is worth to you. If you sold it tomorrow, you sold up shop, how much would you be getting back at the end? When you sold it, how much is it worth? And the idea is to drive up your owner's equity over time. So you invest your time and effort in the business grows and grows and grows. Owner's equity will eventually go up as you move along. And if you sold the business, that would be how much money you'd get at the end. After you paid all the bills, owner's equity is what you get at the end. So, for any small business and any business, it's very, 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 very important that you can do this measurement. And the way you do this measurement is you need to keep track of all your invoices, all your receipts, all your payroll records, all your bills, all your bank statements, tax forms, tax remittances, credit card statements, all these sorts of things. This is what is so important to be able to measure how well your business is doing. If you got those records, you can use it to calculate as accurately as possible how well your business is doing. Revenue Canada will look at it and say, if you don't do a good job recording it, you could be out of it, and that could cause cause you problems, but it'll cause you a lot of grief and money in terms of getting this stuff done. So you can't underestimate the value of good record keeping track of your bills. So I can't overstate that. So your accountant or bookkeepers are usually who you hire to keep track of your books as you go along, record the revenue and the income and that sort of thing. An accountant will look at it and say, okay, from a tax perspective, this is how the statement has to be set up and the like, so that Revenue Canada's happy, your bankers are happy, these sorts of things. But these fundamental statements, the basic statements of origin, are very important. And another thing that it does is it helps reduce the chance of getting ripped off. If you got hard statements and records and you wonder where money is going, the statements could lead to where your problems are, could certainly reveal that information. So basic bookkeeping and accounting principles say, make sure you keep track of your records. So that's something that we absolutely need to do. Very well organized. Now, the final thing I want to look at was this issue of comparative analysis. And this really goes a little bit stronger in scope than what we really want to look at in terms of your basic understanding. But I guess what I wanted to tell you here is that there are several tools that accountants and bookkeepers and people in business use in order to measure the health of a business on a number of fronts. And one of the fronts is comparative analysis. And we've already looked at that when I showed you, okay, well, let's look at 2018, let's look at 2019, compare, are we doing better? Are we doing worse? That's what's called comparative analysis, which is really asking what's changed, okay, between one year and the next. But there's another thing that we often do too called ratio analysis. And ratio analysis kind of figures out one thing compared to another thing. And we compare it from one year to the next, or we compare it with industry averages. I just demonstrate that. That's the comparative analysis. I'll just hop past that. We looked at our comparative analysis already. In terms of ratio analysis, what we wanted to be able to do is to compare certain bits of information against one another to get a sense of how well the business is doing. They tend to fall into four basic categories. Something called liquidity. Liquidity is just a fancy way of saying, can we pay our bills? Are we what's called liquid? A business is liquid when it has enough money to cover its bills. Okay? And we hear tell companies being liquidated. Liquidated means just selling stuff so you can get some money. We also have another thing called leverage. And leverage is just a fancy word for borrowed money. We borrow someone else's money in order to make more money ourselves. So you borrow money to buy a piece of equipment that you can use to make money. That's what's called leveraging. The thing is with leveraging is you're going to have to pay that back. It's a loan, money in our name. You need to make enough money to be able to pay the loan back, cover the interest cost, and these sorts of things. So a leverage ratio is measuring your ability to repay loans. Solvency ratios. Solvency is just a fancy word for, do you have any money? Is there money at the end? Is there enough money to keep the business going? And return ratio is what banks look for. And that's no different. When you put money in the bank, you get an interest on your money. Okay. That's what's called a return. 2%, for example, 2% rate of return. That's a return ratio. In other words, if you put $100 in the bank, you'll get $2 in interest. That's the return ratio. Same thing with business. If you've invested $1 million in your business and you get $2 in return, you're going to say, that's not very much. That's not a good. But if you're making $200,000, that's a good ratio, right? So a return ratio is just kind of looking at, am I making any money on this? So liquidity, as I say, is this idea of, can you pay its bills? A very simple liquidity ratio is something called current ratio. The current ratio just takes a look at, it goes and looks at the financial statements and it finds the current assets and the current liabilities. And keep in mind that current assets are assets that can return to cash within 1 year. So they're inventory, cash, accounts receivable, fairly near cash stuff. And current liabilities are stuff that bills that you got to pay within 1 year. So if you got money that you can have in 1 year, money that you can get in terms of money in 1 year, and money that you got to pay within 1 year. If we compare the two, we want enough money to be able to pay the bills. So our current ratio is just saying to ourselves, do we have more money available than we need to pay out? That's all it really is. And it's just a comparison. So if you had $10 in money available, current assets, and $1 in current liabilities, stuff that you had to pay bills that you had to pay, you have $10 to pay $1. That's a good thing, isn't it? High current ratio. You got enough money to pay bills. Now, if you had $2 in current assets, meaning money that you had available to pay bills, and you had $10 in bills that you had to pay, so you have $2, you got to pay 10. Not good. So what your current ratio is trying to do is just doing a comparison of how much money you have available to pay the bills and how much bills you have to pay. And it's just current assets divided by current liabilities. Now, there's another form of this called the quick ratio. Quick ratio is the exact same thing. It's just you take out your inventory. Because maybe you got ugly carpet. Maybe you're a carpet salesman and you have a roll of ugly carpet that nobody's going to buy. You say it's worth $10,000, but nobody's going to buy it. Is it really worth $10,000? So all the quick ratio does is it takes our current assets and subtracts off inventory. And it looks at how much you got after subtracting off inventory. In other words, that ugly carpet you're not going to sell. Let's take that out of the mix. How much do you have? How much do you owe? Compares the two. So that ratio analysis is a cool tool to be able to determine ability to pay your bills. We also have, as I say, leverage ratios. Leverage ratios, just all that really does is says, who's paying bills for this shop? Is it somebody else? Is the money coming from somebody else, or is the money coming from you? And if we look at leverage ratios, we have something called a debt ratio. And the debt ratio is how much money do you owe outsiders versus how much do you have in assets. So what we're trying to do there is to say, who's paying the bills? Who's paying for all this stuff? Is it you, the owner, or is it somebody else? And if you owe a lot of money for all the stuff you have what's called a very high debt ratio. In other words, you owe a lot of money on those assets. The high debt ratio means you got to pay the bills, you got to pay the interest, you got to cover that. So any business, when you do a debt ratio, which is really our total liabilities divided by our total assets, you want to have enough of your own money put into this, in other words, not a lot of liabilities, to pay for those assets. If you owe nothing to anyone and your business is debt-free, your debt ratio is fantastic because you have no debt, right? However, if you owe $1 million for your assets, and your assets are, I don't know, $1 million, you're owing all that to somebody else. So you have a very high debt ratio. We can also look at a ratio that looks at what's called debt equity. In other words, how much do you owe to outsiders versus how much does the business owe to you? And if most of your business is financed by outsiders, that's what's called a high debt to equity ratio, meaning somebody else owns the business, not you, and that you need to pay their bill. Solvency ratios, as I say, measures the size of the company's profitability and compares it with its obligations. Does it have enough money coming in to pay the bills? Okay. So interest coverage ratio, in other words, is a fancy term called times interest earned. In other words, you look at your profit of your business and you ask yourselves, how much do I owe in interest and how much more profit do I have to be able to pay the interest? In other words, my profit might be $10, my interest is $1, it's 10 to 1. Whereas if my profit's $1 and my interest is $1, it's a 1 to 1. So we want to be able to have a higher times earned than we do. And debt service coverage ratio is basically just measuring how much your income is going towards paying your debt. If you're making $100,000 a year and you got $100,000 in interest expense, that's not good. Your debt servicing sucks all your money, right? You're very laden with debt, so you got to pay your bills. Again, the focus of this is to understand the basic concept of these tools as opposed to being able to use them. I do have the mechanics of it there. And we also have the rate of return. Rate of return is no different, as I say, in your bank account. How much do you make in interest? And all we're trying to do is look at how much are we making in terms of money on this. Well, one type of rate of return is return on assets. So if you got $1 million in assets and $100,000 in income, 100,000 on $1 million is 10%. So that's like a 10% rate of return. That's pretty good in today's world. Whereas if you had $1 million worth of assets and you only had a very small income, you're not making a lot of money and very low rate of return on assets. And return on equity is very similar. Equity is how much you own of the business. So we look at our owner's equity and we ask ourselves, how much income is the business drawing in? $1 million worth of income and $1 million worth of own equity, let's say. So you're making a one to one. You're making $1 for every dollar in equity. Is that good enough? It might not be. So these tools are often used in accounting and in the finance business in order to really get a good sense of, do this business generate enough to stay in business?